if, like in the 1970s, purchasing power of the US dollar declines by 75%, I would expect a substantial rise in the gold price. When people, including your listeners, Tom, have asked me in the past, when is the gold price going to move? I say, 2000. From 2000 to now, it's moved from $253 to $2,700. That's over 8% compounded, which is to say that gold has maintained its purchasing power for 24 years. My belief is, unfortunately, that the rate of deterioration of US dollar purchasing power is going to increase. And as a consequence of that, the gold price is going to increase in almost commensurate fashion.
Analyst Rick Rule emphasizes that gold has demonstrated robust growth since 2000, with an annualized rate exceeding 8%. This consistent performance highlights gold's ability to preserve purchasing power over the past 2 decades, as dollar depreciation accelerates. Rule anticipates that gold prices will rise accordingly, reinforcing their role as a hedge against inflation and currency devaluation. In a notable move, Zimbabwe launched a gold-backed currency called ZIG in April to reduce the country's reliance on the US dollar. By floating this new currency across various sectors for transactions, the government has taken a calculated risk to stabilize its economy. Meanwhile, developments in global currency markets are impacting the dollar's value. On Thursday, the dollar fell against the yen following less dovish comments from the Bank of Japan, alongside U.S. data indicating easing upward price pressures. This suggests the Federal Reserve will likely proceed with a 25 basis point interest rate cut next week. Data released on Thursday showed a slight uptick in U.S. consumer spending for September, positioning the economy for higher growth as it approaches the end of the year. As measured by the Fed's Preferred Personal Consumption Expenditures Index, inflation registered a year-over-year increase of 2.1% in September, down from an upwardly revised 2.3% in August and still within the Fed's target of 2%. Given the prevailing challenges of national debt, Rule believes that the U.S. will likely resort to inflation as a strategy to manage its debt obligations. This approach could lead to a further decline in the dollar's purchasing power, which in turn is expected to drive gold prices significantly higher. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
The Federal Reserve estimates that the total private wealth in the United States, not including the value of federal land, which is unlikely to be sold, the total private wealth in the United States is just under $140 trillion. If you add the off-balance sheets and the on-balance sheet liabilities of the U.S. government at $135 trillion against the net worth of private Americans at $140 trillion, the truth is that there is no way at all, ever, arithmetically, that we can deal with this. We were faced with a circumstance that was similar, but not as severe, at the end of the decade of the 1960s. And the political solution, the problem then, was, I believe, the same as the political solution to the problem will be this time. According to the US government, in the period 1970 to 1980, we inflated away over 75% of the purchasing power of the US dollar. That's how we'll solve the problem. Old codgers like me, who were promised, say, $2,500 a month in Social Security, will get $2,500. But the $2,500 that they get will buy $300 or $400 worth of goods and services by the end of the decade. We will inflate away the obligation, just like we did in the 1970s. Now, relating this back to gold and silver, in the period 1970 to 1981, while we inflated away 75 to 80% of the purchasing power of the US dollar, the gold price went from $35 an ounce to $850 an ounce. Let's be conservative again, and let's say that it was only at $35 because it had been price controlled for years. Let's assume that the free market price of gold in 1970 would have been $100. So the gold price only went from $100 to $850. Fast forward again to the last time that there was concern about the purchasing power of the US dollar, the year 2000. In the period 2000 to 2010, the gold price rose, albeit by a much more modest number. It only went from $253 an ounce to $1,700 an ounce, a seven-fold increase. The way our society proposes to deal with $135 trillion in debt, which is to say, inflates away the net present value of that obligation. And if, like in the 1970s, the purchasing power of the US dollar declines by 75%, I would expect a substantial rise in the gold price. When people, including your listeners, Tom, have asked me in the past, when is the gold price going to move? From 2000 to now, it's moved from $253 to $2,700. That's over 8% compounded, which is to say that gold has maintained its purchasing power for 24 years. My belief is, unfortunately, that the rate of deterioration of US dollar purchasing power is going to increase. And as a consequence of that, the gold price is going to increase in almost commensurate fashion.
Attention from investors and analysts is rising. Rick Rule anticipates that upcoming earnings reports will further renew investor interest, particularly as gold continues its upward momentum. Agnico Eagle has a consensus rating of strong buy among analysts and a price target of $93.81, reflecting an 8.13% upside potential from its present levels. Stifel Nicolaus also reiterated its buy rating for Agnico in an October 21st report, setting a price target of $40 Canadian. Newmont Corporation, another prominent name in the sector, has gained 21.3% over the past 52 weeks and 13.4% year-to-date. However, the stock faced a recent 18.7% drop over the past 5 days, driven primarily by a significant 14.7% plunge on October 24th when it missed its earnings expectations. This volatile performance underscores the opportunities and challenges gold miners encounter amid fluctuating market conditions. For investors, these mixed results reveal the sector's potential for gains alongside exposure to the economic factors affecting precious metals markets. Let's get back to the interview. In my experience, gold bull markets are led by physical gold, and I think in the last 18 months, we've seen...
In my experience, gold bull markets are led by physical gold. And I think in the last 18 months, we've seen the physical gold price has done well in US dollars, even as the US dollar has done well in other currencies. The gold price escalation that Americans have seen is less and later than the gold price escalation that virtually everybody else in the world, including Canadians, has seen in their own currency. And I think that's important. Traditionally, physical gold leads. Then, as the increase in the gold price begins to increase the free cash margins of gold mining companies, the biggest and the best gold mining companies come next. The moves that we've seen, as an example, in Wheaton Precious and Agnico Eagle in the last 4 years the last year, the 40% move in the last 12 months, suggests to us that we are just beginning to see the escalation in the biggest and the best mining companies as a consequence of the gold price increase. That's why I say that the next 1 or 2 quarterly earnings reports are so critical. If we see a follow-through in free cash flow as a consequence of higher gold prices, I think that you'll see renewed vigor among the senior miners, both from the traditional gold community, but also from the generalist investor. What has happened in the past then is that the best of the best, the senior producers, have enjoyed disproportionately large increases in their share prices and market caps. And some investors look for relative value. They go to the second-tier producers or they go to the developers. And the second-tier developers or producers who don't experience increases in share prices get taken over by the majors. Those people who have a lower cost of capital have a decided competitive advantage in a capital-intensive business like mining. So if the market doesn't arbitrage out the respective valuations, you see M&A. and you're beginning to see M&A in the sector now. A couple interesting things happen after that. One is that sort of halfway through a market cycle, when the generalist investors are attracted to the precious metals narrative, with momentum having been established by gold, when they come into the market, silver takes over leadership. I'm not sure why. Maybe they're attracted to its historic volatility, maybe the lower unit price. I don't know why. I just know that in that period, equity leadership changes from the biggest and the best of the golds to the junior producers, the developers, and of course the penny dreadfuls. Interestingly, at that point in time, often the worst companies do the best because they exhibit the highest leverage to the gold price. The silliest moves of all are in those few high-quality silver companies. Now, it may be that there's so much liquidity in the system now that the traditional market response has been disjointed. When I described the silver juniors as a coiled spring, the reason I did that is they were so hated. And the moves that we've seen in names like, Abra Silver, Vizsla Silver, Aya Silver, I think have as much to do with the dead cat bounce as anything else. But it could be that this time the market will be more speculative.
Miners see fluctuating but promising performance. The role of gold as a stabilizing asset remains evident. These trends signal that gold's upward momentum could persist amid inflation and economic shifts. With inflation-driven debt strategies potentially devaluing the dollar further, how might gold's role evolve in managing wealth stability for both nations and individual investors? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.